Hello everybody, this is AK. I'm back. So I read a headline in the Straits Times that says more companies in Asia, including Singapore, are headed for bankruptcy. And reason is the persistently high interest rates are putting stress on corporate balance sheets. And there are increasing numbers of firms that are facing this issue. And of course, this is something I've been talking about how if we are investing, we should look at the balance sheets very carefully, and we want to invest in companies with strong balance sheets. Because interest rates are higher, much higher now, and they are likely to stay higher for longer. And I've also shared reasons why they could go higher, but crossing fingers that the US Fed is really done and they won't be increasing interest rates any further, right? Crossing fingers. Well, of course, it's not just higher interest rates that we're dealing with. We are also dealing with much higher bond yields. And that, of course, has caused a lot of stress for the banks in the US, and any bank that's been holding very long-term bonds with very low coupons, right? And so the market prices of those bonds have fallen, and that has affected their balance sheet. And we saw some regional banks in the US going under, right? That went under, went bust because of that. And this is all going to have an effect, right, on the wider economy. And it will have an effect on REITs, right? For those of us who are invested in REITs, we have seen how REITs unit prices have plunged. It's because investors will compare the returns that we can get from REITs and from bonds. And on one hand, bonds are risk-free, and REITs are not. And on the other hand, when we look at the returns, REITs are very similar to bonds in the sense that people invest in REITs mostly for income, right? So for sure, making a comparison in terms of the returns you can get from bonds and REITs is something that people quite naturally would do, right? Even though they are not exactly the same thing, right? So if bond yields stay higher for longer, then REITs, unless they are able to show that they are able to generate a lot more in terms of income to compensate, right, for the risk, they will see their unit prices coming under pressure. That's for sure. But like I say, as investors for income, we are more interested in the income. We are not so much concerned with the market prices, as long as the REITs that we are invested in are fundamentally sound, strong balance sheet, and are able to continue paying us, then it's okay, right? It's not bad, per se, right? But it's also going to affect businesses, right? High interest rates, like we saw just now in the headlines, how it's going to affect businesses, right? It's going to affect their funding costs. But also the higher bond yields means that businesses which have been used to issuing debt to fund their operations would find it harder to do so, or if they should do it, the cost of funding would go up, right? Because the coupons they have to offer would have to be a lot higher, right, for their bonds. So we hear the thing like junk bonds. Junk bonds are non-investment grade bonds issued by some companies because they need the money to function. And I've said before that in such an environment, to buy junk bonds just because of the yields, I think we have to be very careful, because we don't really know if the businesses will go under, especially if a recession comes in 2024. And I think it's likely, if bankruptcies increase in 2024, that would mean joblessness would increase in 2024. And like what I say in the thumbnail, all are at risk, right? So we have to stay prudent, right? And I think it's better to err on the side of caution and not be too adventurous when it comes to investments, and not to be too free with our money, right? And even if we are landlords, like if we are investing in properties, for example, and not REITs, just physical properties directly. I mean, anecdotal evidence is that the rental demand has eased, and asking rents have come down, right? It's a bit harder now to find tenants for residential properties, for example. That's the thing that I've heard recently. So it's not the kind of a boom situation we had just maybe a few months ago, right? So all are at risk. This recession is probably coming 2024, and that's why some people are saying that the US Fed could start cutting on interest rate in the second half of 2024. But of course, that's anybody's guess. But based on what we are seeing now, right, on the ground, it seems that the recession is coming in 2024. So be prepared, have a war chest ready, but before that, have an emergency fund ready, especially if we're still employed and if we need our jobs, right? Okay, so that's all for now. Bye-bye.